Data Derivatives podcast. I'm here with Greg Guttas and Simon Nursey of Flowdesk. Guys, how are you?
Doing great. Thanks for having us, Greg.
Absolutely. So, Greg, you are the head of OTC at Flowdesk, and Simon, you are the head of derivatives over at Flowdesk. Before we jump into everything Flowdesk and what you guys are doing over there, you guys have both like really extensive backgrounds in TradFi and finance in general, including crypto. I kind of like to jump in there. Maybe Greg, we could start with you. You had a pretty big career in the ETF space, doing like redemptions and creations and everything of that nature. Maybe you could give us a quick rundown of what that looks like and what that means.
Yeah, sure. So I spent the majority of my early career at Credit Suisse. I worked for an equity desk, which was called the program trading or portfolio trading, depending on which firm you were at. And effectively what that meant is we were trading the underlying portfolios of ETFs. So not the ETF itself always, but we were either rebalancing the portfolios that these ETFs held, or we were doing, as you noted, the creation redemptions for these ETFs. High level, what that means is an ETF is simply a wrapper for a basket of stocks. If we're talking about like SPY or QQQ or any of the main equity ETFs you've heard of. And so when an ETF gets an inflow, or when someone wants to buy that ETF, that fund needs to then go and source all of the stocks within that portfolio in order to not dilute the rest of the rest of the shareholders. And so that's typically done through a desk like ours at Credit Suisse. That process obviously goes to more than just the equities. It came to the crypto world as well. And so when the Bitcoin and the Ethereum ETFs launched, we ran a pretty similar process that Flowdesk was a part of, where when investors would go and buy IBIT or GBTC or any of the other crypto ETFs, what that would require is the ETF issuers to go out and buy the Bitcoin or the Ethereum to hold in the portfolio to reflect that investor's share of Bitcoin or Ethereum. And so that also was often done through a desk like Flowdesk. And so it's sort of a merging of two worlds for me.
Yeah, that's really interesting. That makes a lot of sense to me, especially at an end of day basis. But stocks trade in milliseconds. What happens if someone just comes and buys a ton of Nvidia and theoretically the SPY ETF hasn't reacted alongside it yet? Is there some sort of divergence that can happen between the underlying portfolio and the ETF value?
It can. It's typically very fast, as you mentioned. These the firms that are trading and market making these ETFs are obviously highly technical firms, and they are reacting within milliseconds, as you just noticed. So typically any dispersion between the underlying portfolio and the ETF trading in the secondary market on 99.9% of the time is going to be such a short period of time that you would never notice it with the naked eye. It takes a pretty crazy event for those prices to deviate. And so, you're talking about something like COVID, or you're talking about a new event like all of the crypto ETFs launching at the same time. That's sort of the type of event it would take to have the ETF itself and its price on the secondary market really deviate from the underlying of those ETFs.
And then what about something like IBIT, where you're basically trading an equity ETF, but you can't necessarily buy Bitcoin in the equity space to mimic the ETF. So what's the discrepancy there if you have to go on chain to go buy Bitcoin, and then how does that all work?
Yeah. So typically what will happen here is an ETF market maker, right? There's a number of them in the space that are pretty recognized names. You could be Jane Street, Citadel, Susquehanna, or some of the main ones. Typically, they're making two-sided markets in these ETFs, and so they'll be willing to buy it from you at a price, and they'll be willing to sell it to you at a price. What typically will happen is if you come in and you want to buy $10 million of IBIT, right? Somebody like Jane Street will make you a market in that $10 million block of IBIT. They'll sell it to you, even though they don't currently have it today. What they will then do is they will actually go buy $10 million of Bitcoin, and they'll usually do that through either Bitcoin spot itself, and they'll buy it on an exchange like Coinbase or on Binance or wherever they're comfortable trading, or they'll buy a Bitcoin derivative, right? That could be a CME future, that could be a
Mm,
perpetual future if they're trading on offshore exchanges. And so that basically allows them to have sold an ETF that they don't have, and they've covered their risk of shorting that ETF by buying a product that will react in an identical way. So no matter what happens with the price of Bitcoin after that trade is done, they're perfectly hedged. At the
yeah.
end of the day, what they would go, that goes into the creation redemption mechanism that you mentioned. At the end of the day, they will go to BlackRock and they'll say, hey, I need to create $10 million of IBIT. And um, IBIT will go out and they will source that $10 million of Bitcoin themselves. Now, how this typically works, and this kind of goes to, there was a lot of talk about the in-kind creations versus the cash creations early on when these things were trading. The way it would typically work is Jane Street, having already bought the Bitcoin, they would just give that Bitcoin directly to BlackRock. BlackRock would then give them newly minted ETF shares, and everyone walks away happy. When there's a cash creation process, it becomes a little muckier where BlackRock has to go out and buy the Bitcoin, and then whoever that market maker was would have to sell the Bitcoin they bought at the same time. And there would be some level of slippage there when they do that. But ultimately, um, it's sort of the same end game with a little bit more of an operational hurdle to make it happen for the low cost transactions that we all come to expect in the trading world. So that's sort of the mechanics for how the Bitcoin will end up, starting with an investor coming to buy an ETF until the Bitcoin actually makes it into the BlackRock trust that holds the Bitcoin for the duration.
Yeah, okay, that's very interesting. I got a couple more quick ETF questions and we'll jump to the vol side of things. But
Yeah.
speaking of vol, there was these vol ETFs that they're back now, but I remember trading in February 2018, aka Volmageddon, when a lot of these inverse vol ETFs like XIV ended up blowing up and going straight to zero. Kind of what happened there? Why did an ETF drop from $70 a share to overnight to $0 a share essentially in the morning when the market opened again?
Do you want to take this one, Simon?
Yeah, perhaps I'll take that one. Yeah, I mean, I was trading FX at the time, but we were watching this one closely because it had been flagged out there. I think Zero Hedge brought it up quite early. It was quite a badly designed product in that the sizes were just exploding and had gone way beyond the liquidity of the market. And we also had a very you could calculate exactly where the stop loss was for this fund.
Mm.
And whenever you have a sort of well flagged stop loss that the market can focus on, we inevitably go there, right? So that's what happened in the end. We knew where the trigger on VIX was, and everything unwound after that back to zero. But it's exactly the same as we saw. Yeah, whenever there's a line in the sand, whether it's Bank of England and the ERM,
Mm.
or it's UST, right, where you could monitor exactly how much collateral there was and what was backing it. So the car crash was there, ready to happen well before we got in the car.
Yeah, that's interesting. And you mentioned that the size of the ETF, like I think they were using VIX futures to hedge, and the VIX futures market wasn't as liquid as all the assets under management of the inverse ETF. Is that part of the problem? Did I understand that right?
That's right, and as vols went lower and lower, there was convexity, which meant that the sizes had to increase and increase.
Mm.
So yeah, it didn't start out bigger than the market, but it finished bigger than the market.
Very interesting. And so, Simon, kind of jumping into your side of the career. So, I mean, you spent 17 years at as the head of FX options over at BNP. That's a pretty OG career right there. Like, what does that mean? What does head of FX options do at a big bank like that? What kind of responsibilities do you have?
Well, I didn't start out as head of options. I started out as a junior geek on the desk. I was what you'd call nowadays a desk quant, and yeah, sort of went about becoming the global heads the long way around. So took an opportunity, came to Singapore, traded the exotics, then traded structured products, then traded the flow, and each time making a little bit of money and being pushed up the chain. Managing big bank risk managing a global desk of 50 odd traders is not really about trading. The smart guys do the trading. You're too far from the market to be able to do that. It's really about managing a team of talents, and traders can be challenging to manage, yeah, and motivate, and drive forward and bring together, and that was the main part of the job, really, sort of making sure that everyone was kind of working towards the same direction. We're managing our overall risk, and making smart decisions, and looking out for the pitfalls. It was. So the job ultimately was quite far from trading, and more about just people management and communication, and navigating the sort of increasing number of rules and regulations, and capital and balance sheet and all of these technical things.
Yeah, that makes a lot of sense. And is a lot of the trading flow mostly facilitating customer needs, like someone wants to do some exotic trade and you take the other side and price it and all that stuff, or do some of those traders also, look at the vol surface and essentially just make discretionary bets on what they think should happen as opposed to what's being priced right now?
Yeah, all of those things. So the playbook, or my playbook is exactly the same as what we've built at Flowdesk. So you start with a desk that's servicing client flow. You give them the top service. You try and generate as much flow as possible, and then you use that to increase your presence in the market. You provide liquidity to the market as well, and put yourself at the center of all of that flow. And then use the information from all of that flow to take a directional risk yourself, and leverage all of the information that you're seeing and the liquidity that you have access to. So a top performing options desk is one that is taking risk, it's servicing clients, making markets, seeing the flow, and then managing out. And if you can sort of put yourself in the middle and see everything, you're in a really strong position, and very difficult to displace.
Yeah, that's very interesting. The network effects of having a lot of clients gives you a lot of insight on what's actually happening in the market. That's an interesting perspective. And then, what kind of clients usually trade FX or FX options? Is it just bank to bank, or is there hedge funds? How does that work?
Oh, well, it depends on the institution. At BNP Paribas, we had a lot of global corporates, hedge funds, asset managers, plus all of the private banks. For your business to be successful, you really want to try and balance all of the flows, and then leverage on that. So for instance, a very strong part of our business was at Stan Chart, say, where we would receive Vega from all of the structured products that we were selling into Asian small corporates and private banks, and then recycle that Vega, normally in renminbi or yen or won, and recycle that Vega to US funds that were had a strong appetite for that. So you sit yourself in the middle, and then try not to have to rely on market liquidity, and you get in a pretty good place there.
Yeah, that's fantastic. So, kind of moving on to Flowdesk. So, obviously, you guys do both spot and derivatives. Maybe Greg, if you just want to kick it off, what does Flowdesk do, and what kind of trades do you guys facilitate, and what kind of customers do you guys have, and things like that?
Yeah, sure. So I guess taking a step back on the Flowdesk side, um, Flowdesk was founded back in 2020, and the primary business here was actually token market making on both centralized and decentralized exchanges.
Hmm.
So, the standard model that we operate under is what we call our market making as a service. And essentially what that means is um, token protocols who want to launch a token, they will pay Flowdesk, usually in the form of a retainer, to use our market making software, our operational excellence, all of the infrastructure we have here at Flowdesk to make sure that their token has liquidity on the exchanges, both centralized and decentralized. So, traders and investors can, seamlessly trade in and out of their tokens, when they want to. So that was sort of how the firm was founded. That business model on the market making side has expanded to exchanges as well, where exchanges will pay us to provide liquidity on some of their markets. Typically if there are altcoin markets that are maybe not as much natural two-way flow, or if they're bootstrapping perps on their exchange, there's certain events that might cause an exchange to want to pay a market maker like Flowdesk to basically ensure that there's liquidity in their markets at all time, for their traders that are using their platform. With that, we started a OTC desk here back in 2023. There were a few of us from Genesis on the sales and trading and operations side that, when Genesis went down, we all basically wanted to restart the good parts of Genesis, which was, the trading. There were a lot of good parts of Genesis, but our specific area of expertise was the OTC trading desk there, which was at the time the biggest OTC trading desk in the market. And so we came here to do exactly that. Now, the services we offer here, we're a full-scale OTC desk. It starts with the spot trading that is, typically, just an easy example is somebody will come in and say, hey, I want to buy 50 Bitcoin. I will show them a market on 50 Bitcoin. Typically, it'll be above where the current spot price of Bitcoin is. And if they accept that price, their price is locked in. It's incumbent on myself and my team to hedge that risk and to make sure that, we're sourcing that Bitcoin cheaper than where we just sold it to our client. And it's sort of a one-stop shop for customers to not have to deal with exchanges, to not have to deal with like asset movements to and from exchange, and to have that counterparty risk. And so that was sort of the foundation of the OTC desk. With that, we built out a credit desk, which is, fairly straightforward. Customers want to lend us assets to earn yields, or they want to borrow assets for, a number of reasons. It could be borrowing cash to lever up and buy more coins. It could be just pure operational cash. It could be borrowing Ethereum to short. There's a number of reasons folks would use a credit desk for their trading or personal needs. And then most recently, we started our derivatives desk with Simon joining us, and so those are sort of the three main pillars of the OTC desk here.
Yeah, fantastic. There's a couple questions I want to follow up there. So, with the market
Mm-hmm.
making as a service, a lot of protocols, I'm sure listeners know, the way that they've been launching tokens is essentially doing an airdrop. When you're doing market making as a service, how do you avoid just kind of getting hosed when the airdrop happens and everyone just sells to market makers, essentially? Is that part of the negotiation up front, or how does that part work?
Yeah, so in the market making as a service model, the assets that are used for trading are typically the protocols themselves. And so, they'll actually provide both the coin to be on the offer side and like Tether, for instance, to be on the bid.
Mm-hmm.
And so, typically
Mm.
they will be the buying source when there are, part of this supply is airdropped onto users. They will typically be there to buy some, to basically act as buying pressure to absorb a lot of the airdrop selling. The price will naturally find an equilibrium, and then everything will go back to being a little more two-way. So that's typically the model for the market making as a service. When you're talking about when Flowdesk is market making with their own with our own principal funds, we obviously have to be a little bit more careful in terms of the markets we're making, but we'll have, we'll have contractual obligations that we need to be have X amount of depth within, 1, 2%, 50 basis points, whatever the negotiated terms are. We have to meet our obligations, obviously, from our contract, but it definitely is, not the easiest thing when a large amount of the supply is airdropped. It's a total mixed bag, though. How these TGE events perform very much. They depend on the environment at the time of the launch. It depends on what the token is and how much organic user growth there is, and do people even know about it? And so, it's a total mixed bag. It's a very difficult thing to do. It's one of the hardest things I think we do as a firm, is that initial launch.
Mm-hmm.
Liquidity is very, spread out across all these exchanges, and we're trying to keep prices in line. And so it's certainly a tall task for us, but it's what they pay us to do.
Yeah, fantastic. And Simon, on the derivative side, what kind of markets do you guys offer? Is it just Bitcoin and ETH, or will you guys make markets on altcoin vol and things like that as well?
Yeah, no, we're all over the altcoin vols. Because of the nature of our token market making. We talk to a lot of foundations, a lot of funds, and out of that, most of the interest is out there on the alts. We put together prices on most options in the top 500.
Hmm.
Yeah, and try our best to build surfaces around that, which, as you know, is a bit of a challenge. BTC and ETH is where the big volume stuff goes through, and so we're providing liquidity around that. And and this week we plugged into the Derivs RFQ platform, so we're providing access there. But probably the more challenging part of our book is the odds.
Yeah, and working with the foundations, that makes me kind of think of the story you told me about sort of the Asia FX flow. So I imagine the foundations are suppliers of Vega to you guys, and then speculators or funds would be buyers of Vega. If there's like a perfect customer to take the other side right away, that's great. But what do you do if you are just getting supplied with Vega, or short Vega if there's a lot of speculative demand? How do you hedge that out when there's not a altcoin listed market anywhere for you to hedge out with a direct hedge?
Mm-hmm. Yeah, you're absolutely right. Yeah, there are a lot of similarities between our business with supply and demand with the other markets. But generally we receive Vega from anyone sort of looking to generate yield on their assets, and then we actively axe that out to customers that we think might be able to take advantage of cheap volatility
Mm-hmm.
through call spreads, call spread flies, these sorts of structures that allows them to get leverage and exposure to the top side. Because we've got a pretty strong network, both on the foundations and the hodlers, but also the sort of the buy side accounts, the funds. It creates a nice balance. Although obviously it never balances off exactly, and the buyers rarely want what the sellers want to sell, and the sellers really want to sell what the buyers want. So we're managing a big book of various longs and shorts, and hopefully we can sort of manage and balance things out essentially. ETH and BTC provide good proxies for sort of overall crypto volatility, and we're active there to sort of try and balance the overall book, but they're far from being good hedges, right? Especially if you look at the price action over the last week, where we've seen sort of BTC and ETH vols come to the fore, whilst a lot of tokens have stalled. It's makes for quite a challenge, But if you sort of have a big enough and diverse enough book, you can sort of get around all of that.
Yeah, that makes a lot of sense. So I imagine the flows from all the token protocols. So you have a bunch of you're long a bunch of Vega from that, and then you go to sell like neutralize some market Vega by selling some Bitcoin and ETH, and then you have this market rally where Bitcoin and ETH kind of get some life to them, and then the alts don't do anything. That's kind of not the best spread at the best time. I can see what you mean
Yeah,
there.
yeah. But that's where the trading aspect comes in. That's where you need to have a risk-taking desk in order to provide liquidity.
Hmm.
We're there, not to do the trade, not necessarily to do the trades we want to do, but to do the trades that our customers want to do, and then make sure that goes through at the right price. We've got good risk appetite, so hopefully everything comes together.
Yeah, fantastic. And obviously we've had a lot of interesting events, vol events, so to speak, in crypto. The FTX banking crisis, or the FTX bankruptcy, the SVB banking crisis, things like that. Is there anything in FX that stuck out to you as big stories while you were trading? I'm sure the 1997 FX Asia financial crisis might have been one, but is there anything that's similar to crypto in terms of those events, or is crypto its own beast?
No, we've seen no, obviously in FX with a career that long, you see plenty of crisis, they're the moments that tend to define your success as a trader, right?
Hmm.
It's how you manage your way through those and manage the liquidity. That's when you're challenged the most. In my first year of trading, we had LTCM,
Mm.
which was quite interesting in that here was an enormous hedge fund with massive positions, and when they went down, markets that should have been uncorrelated, Russian debt and dollar yen and VIX. Suddenly became massively correlated, and everything was moving together, and we saw moves that we've never seen before.
Wow.
The crisis that stands out the most for me is the GFC. Yeah,
Mm.
and we haven't seen anything like that in crypto, to the extent that it wasn't just a market crisis. It was something much more existential. I was managing traders that were dealing with difficult positions, but also having to question everything that they'd assumed before.
Mm.
The access to capital, access to borrowing, where's the deposit markets, even things like will the bank be open tomorrow when I try and take money out. It was quite a different level of crisis, and an interesting one to manage our way through.
Yeah.
Um, Crypto, though, in 4 years of trading crypto vols, I think we've easily covered 20 years worth of sort of highs and lows and balls and booms. It's been pretty crazy.
Yeah, absolutely. That's I remember the Great Financial Crisis. That was definitely a scary time for sure. Greg, on your side with the spot desk, so I imagine some speculative funds or buy side funds might have a really strong opinion on some altcoin that has very little float. They might know the founders. They might know an announcement that's going to come out that you know who has time to keep track of every token fundamental event. How do you deal with that low float tokens and getting sort of big buy orders? Obviously, there's
Um,
asymmetric risk when you're short that.
yeah, for sure. So you're right that that exists. I think in practice, you know, I've been doing this for a number of years, and there are very, very, very few scenario or situations that I can point to where, a client of ours actually used some level of information that, um, that asymmetric information that you're kind of referring to, where they've actually used that directly against me or my team. Um, a more the way that would in theory happen was they would ask you for a risk market on a coin that they knew was going to move one way or the other based on some piece of information that's going to come out. And you're exactly right, right? Like there's hundreds, we trade 500 plus coins on the desk. Like there is no way for us to keep track of every coin that we're trading and have an opinion on, where it's going to move. And so we have opinions on where the market generally will move, but on a coin by coin basis, we can't manage that at all. And so we might be trading against a fund that has 12 positions and they know all of these positions intimately. And we only, know them from it's a ticker and we generally have a market view. So there's certainly an information asymmetry there. In practice, we have good relationships with our clients and they typically won't stuff us with the position that we wouldn't know about for those reasons. And so they can sort of shift the execution strategy to like, hey, can you help me sell, X million dollars of this token, or hey, I'd like to buy this token, and then we can we can buy it for them and sort of pass through the price. And so, we're not going to get stuffed in that manner. And so there are ways to get around that where if someone wants to get into a position urgently or get out of a position urgently, without stuffing us with that position, we can certainly make that happen. Obviously it has happened to me and it's no fun. And I'll make a market and 3 minutes later it's 15% in my face. And I'm like, what the hell just happened here? So it does happen from time to time, but it's pretty rare at this point.
Yeah, okay. That's good to know. And maybe this happens more on the convexity side, Simon, but do you ever have a customer? I mean, counterparty risk is a big risk with over the counter markets. Do you ever have a customer who's on the other side of a pretty big losing trade? Maybe they sold a bunch of risky tail options that blew up in their face and they try to back out of the trade. Does anything ever like that ever happen?
Um, well, yeah. Have we had customers that have been in difficult positions and struggling to manage the risk? Yeah, yes, of course. Back out of trades? No. We trade. I mean, all of our OTC trades are done under strong ISDA CSA agreements. We set collateral aside. Credit is something that's always in the front of our minds when we trade it in the OTC markets. So we manage that very carefully. One thing that I'd sort of add to what Greg was saying about relationships. OTC is a very relationship driven market, right? We build relationships over time with our customers, and with that comes trust. So we understand where they're coming from, how they deal, how they behave, and vice versa, right? So that's kind of the big difference between that and say the listed market where you trade in anonymously, and you can probably assume that the other party has more information than you. But in OTC, it's much more professional, much more institutional, and it's too small a market for people to be systematically ripping each other off. Saying that, the safest way to trade in crypto is really to come with a little bit of what's the word, deference, and always sort of assume that the other party's got more information, and then scale your risk appropriately. There's no room for, no one with a massive trading ego lasts for long in this sort of market.
Yeah, that makes sense. So we just had the announcement that Coinbase is buying Deribit. So that's kind of an interesting development for the crypto vol space. Obviously, the crypto vol space is still pretty small. Do you guys have any opinions on that? Do you guys think that's a good thing, a bad thing, indifferent? Maybe Simon, I'll start with you.
Well, yeah, no, I think it's a great thing, right? I've been a long time fan of Deribit. They've got They're a really solid team, and they've got a really solid platform. We connect into a lot of different exchanges out there, and it's obvious that Derivs has got some of the strongest infra and best designed exchanges out there, and they've got a dominant position in crypto options. So I honestly think Coinbase has got themselves a bit of a bargain there, but it's also very good for Deribit and very good for the market to have a much bigger capital backing balance sheet behind the exchange. This can only be good for our market because it'll bring in more institutional accounts, more confidence. It'll just be a better, stronger clearing platform. So crypto options have sort of long underperformed the linear part of the market in terms of size. I think this would be the push that allows us to scale up properly.
Yeah, fantastic. Greg, do you have any thoughts or opinions on it?
Yeah, well, I think, to add to what Simon said, which I agree with all of it. I think it's also a pretty notable shift in the U.S. regulatory scene that's becoming evident right now, and this is a headline that you could have never expected to see a year ago. And so I think it's notable in terms of just the overall acceptance of crypto trading within the U.S. The question is ultimately going to be, how much, if Deribit is allowed in the U.S., how much traction will it get here, right? Like we already have CME options, we already have IBIT options. So, had this been done 2 years ago, I think it probably would have had a much bigger impact on Deribit's overall volumes than it will today, just because I think that there are a lot of traders who already have options that are perfectly good for trading Bitcoin and ETH options here in the U.S. But I think it's notable in sort of a regulatory regime shift that we could have never seen back in the last administration, or had this election gone a different way. And so I think that's overall extremely positive for the industry as a whole. And I really hope that it continues to trend this way. I hope it's a very successful acquisition, and I hope that Deribit picks up a lot of volume from this, because I totally agree with Simon. It's a great platform. They have a very strong position in the market. I'd like to see more assets listed there, and I know it's hard because there's not a ton of volume in some of the other names, and I know they have Sol and they have Ripple, and there's a few that are on there, but they just don't have the traction that Bitcoin and ETH have. And so hopefully this helps that along as well.
Yeah, that's a great point. And in terms of IBIT, obviously IBIT's been recently launching options in November of last year, and that's had a lot of good traction. I think the volume's about 35% of the Deribit volume. The spreads are pretty tight. If we looked at CME options before that, those were pretty dead. So that's a step in the right direction for U.S. demand. So maybe that trend continues with more choices with the Deribit acquisition. Before we jump into the personal questions and kind of wrap up here, maybe if someone wants to get in touch with Flowdesk, or they want to execute some trades, or hire your guys' market making as a service, Greg, maybe you could just tell us, where can they find more information?
Yeah, so www.flowdesk.co is our main website. Within there is the ability to reach out to the sales team here with you just plug in your name, email, Telegram handle, short description. That's how a lot of cold calls are made to us, and the sales team does a really good job at monitoring that. We're on Twitter. Our head of marketing is active there. If you want to jump into a reply there, but typically the people that don't know anyone at Flowdesk and are looking to cold call will go through our website and post it out there. And for anyone that's real, obviously, we'll reach out. For anyone that's not real, we ignore. We do see some funny posts there, but we do reach out. We're very responsive there, and that's probably the easiest way to get in touch with us.
Perfect. And we'll have the links in the notes for any listeners who want to go directly to the website. So kind of wrapping up here, I usually do 3 questions, but maybe I'll do 2 each instead. And we'll start with you, Greg. What advice would you give to someone or your younger self for a career like yours?
Yeah. Yeah. Um, so I actually think, and I don't know if the answer would still be the same, but I do think that, it's not a coincidence that a lot of people who are in seats like Simon and mine started off in the same place, and that was typically on a sell side banking trading desk, whether it be equities, fixed income, FX, options, whatever it is. It's a very good breeding ground for jobs like this, right? You learn a lot about relationship building. You learn a lot about managing risk. You learn a lot about just operating within a broader organization, a hierarchy. All of these trading desks are we operate in the same way, whether you're on the sell side in the traditional finance world or in the crypto world. So, I think that's a great place to start. What I look for when I interview young kids, obviously I don't expect them to have experience trading over the counter crypto at all. So, I typically look for hungry talent who is, finding a way to get to me, very active on their own. You don't need to be trading big size, but I typically will ask a couple of pretty simple questions to make sure that I know this kid is serious about the cryptocurrency space, because at the end of the day, that's what you can't teach. We all work crazy hours. If you're working 12 hours a day, you're getting off light. And so if you don't love the space you're in, you're not going to survive and you're not going to succeed. And so if you want to do this, I think you need to be really invested in the overall space, because I think, as everyone who is probably watching this knows, there are weeks, months, sometimes even years where nothing happens, and it feels like you're constantly sitting there asking yourself, like, what are we doing here? Is it over? And then you get a day like today, and it's the greatest place in the world. But these days are sort of few and far between, and so there's a lot more days where you're grinding it out, and you need to have that passion for this industry as a whole to survive. And so that would be my advice, if you're looking to get in this. Just get your hands dirty, start playing around on chain. Take deep dives on Twitter, listen to podcasts. There's a ton of information out there for you to have a very good understanding of what desks like ourselves do. And you'll have a much better chance at getting into an early seat if you do that.
Fantastic. And do you have any favorite trading books?
Yeah, I do. It was actually one of the first ones I read. It was recommended to me early in college. It's Liar's Poker, Michael Lewis. And I think, as I kind of just mentioned, like, it gives you a very good idea. And it's obviously the 80s, or where I think it was in the 80s, was a very different time than today. But I do think a lot of the principles still apply, and a lot of the personalities that you sort of read about in that book still exists on trading desks today. It's really funny. And I think it's a great read for if you want to know what it's like to be on a trading desk. I would certainly recommend it. It's a good read.
Yeah, it's a classic for sure. And how about yourself, Simon? Do you have any advice you would give to someone who would like a career like yours? And do you have any favorite trading books?
Yeah, well, I think Greg hit the nail on the head there. It's the number one attribute you need is to be obsessive, and I'd say we're without a doubt, and particularly watching the chats, all of our traders are obsessive about what they do. It's they're trading their books through the day, and then they go home and PA trade, right? It's they live and breathe crypto, in various different ways, but you can't come into this as a tourist. You have to be embedded. You have to be fully committed. My advice for sort of any budding trader or quant or anything is really you've got to. There isn't necessarily a standard model of what a trader has to look like. You've got to make money, and you've got to make money in your own unique way, because if you do it the same way as someone else, then you're not going to be as good as them. So for me, trading is all about finding your edge, and then leveraging that edge. So for me, I came from more of a technical background, spent a lot of time on models. That was where I made my money. That's how I built my career, and then it sort of developed into other things. Where when I arrived at Flowdesk, the first thing was to sort of work out, okay, what's our edge here? How are we going to compete? And it turns out we've got a great technical infrastructure, really good client reach. So those are the things that we leverage. I think that's it. Identify your strengths, and then work to those. Don't follow someone else's playbook. And books. Liar's Poker is a great book, and I read that just as I arrived in the city. It was that sort of drove me to get into trading. But my favorite trading book is another classic. It's Reminiscences of a Stock Operator,
Yeah.
which be very familiar with, Greg. It's a little bit older than Liar's Poker. What was it, 1920s equity market? But it's incredible. The similarity between the market there and the crypto token market now, it's the same. You've got all of the same behaviors, all of the same market actions, all the same sort of operators, and all of the same lessons. So it's a little bit harder to read with the language, but the lessons are timeless. So I love that one.
Yeah, absolutely. A little bit sadder of an ending as well, but no spoilers. Well, thank you guys. I really appreciate you guys coming on. Learned a lot. Very insightful. And anyone who's interested in Flowdesk, please check out the show notes. You'll see all the links over to the website. Thank you. Thanks,
It's
guys.
great.
Cheers.